Good evening. I'm your host, and tonight we are breaking a story that is sending shockwaves from the boardrooms of Seoul to the trading floors of New York. A leaked recording, allegedly featuring a high-level emergency call from the Samsung executive suite, has just hit the wire, and its implications are catastrophic for the tech industry. We are talking about a desperate 50 million ounce deficit in industrial silver. As Samsung moves towards solid-state battery dominance, they've hit a brick wall of reality. The COMEX vaults are effectively whispering empty. Tonight, we pull back the curtain on a global supply chain that isn't just bending, it has snapped. Is this the moment paper silver fails and the physical era begins? The leaked 50 million ounce demand, the core of tonight's turmoil, stems from rumors of a private admission by Samsung leadership. As the tech giant ramps up production for next-generation semiconductors and silver-intensive solid-state batteries, internal projections have reportedly revealed a massive 50 million ounce shortfall in their 2026 procurement. In economic terms, this isn't just a shortage, it's a strategic crisis. When the world's leading electronics manufacturer cannot source its most vital conductive metal, the just-in-time manufacturing model becomes a too-late disaster. COMEX under siege. The 5 million ounce ghost, while industrial giants are looking for 50 million ounces. The COMEX registered inventories, the silver actually available for delivery, are reportedly dwindling toward a mere 5 million ounces. This 10-to-1 ratio between what is needed and what is available is the ultimate economic hook. We are witnessing a historic decoupling, where the digital price on a screen no longer reflects the reality of the physical vault. As China and Russia tighten export bans on critical minerals, the West is finding that you cannot build a green tech future on paper promises. The battery bottleneck. Every solid-state battery requires a layer of silver for ultra-high conductivity. Without it, the EV revolution stalls indefinitely. The registered collapse. Registered silver stocks have declined over 70% from their 2020 peaks. We are now entering the inventory endgame. The price lag. Despite silver hitting nominal all-time highs of 72.70, many analysts believe the real price, the price paid for immediate physical delivery, is already trading at a massive premium over spot. In the high-stakes arena of global industrial economics, a silent but devastating crisis is emerging at the intersection of renewable energy and advanced manufacturing. The traditional supply and demand curve for silver is not just bending, it is undergoing a structural transformation that the market has yet to fully price in. At the heart of this industrial black hole is Samsung's aggressive pivot towards solid-state battery technology, a move that promises to revolutionize the electric vehicle sector, but requires a staggering volume of silver to achieve the necessary conductivity. When a tech titan of Samsung's magnitude signals a 50 million ounce deficit, it isn't just a corporate procurement hurdle, it is a klaxon for the entire global economy. Silver is no longer just a luxury metal or a speculative hedge, it is the fundamental linchpin of the next industrial revolution. The hook that many investors are missing is the sheer physics of the transition. Unlike previous battery generations that relied on more abundant materials, the solid-state architecture requires silver at a scale that dwarfs current mine output. Economists are now tracking a deficit that is becoming unfillable. Most global silver is mined as a secondary byproduct of lead, zinc, and copper. Therefore, silver supply cannot simply be turned up in response to higher prices. We are looking at a fixed supply asset meeting an exponential demand curve. If Samsung alone requires tens of millions of ounces for its 2026-2030 rollout, where does that leave the solar industry, which is already consuming over 190 million ounces annually? We are entering a zero-sum game for the white metal, where one industry's success necessitates another's collapse. Furthermore, the velocity of this demand shock is unprecedented. As Samsung scrambles to secure its supply chain, the market is beginning to realize that the just-in-time delivery model is dead for critical minerals. This isn't just about manufacturing delays. It is about the fundamental inability to produce the world's most anticipated technological advancements without a metal that is effectively running out. When the leaked panic from the executive suite meets the cold reality of stagnant mine production, the result is a massive industrial squeeze. We are no longer watching a price chart. We are watching a global scramble for the last remaining physical ounces. The question is no longer whether silver will reach triple digits, but rather which industrial giants will survive the drought when the vaults finally run dry. Would you like me to expand on key point 2 to reveal how the COMEX registered? Inventory collapse is making this 50 million ounce shortage an immediate threat. In the sterile, high-frequency world of paper trading, silver is often treated as a mere number on a screen. But the economic reality of the COMEX vaults tells a far more visceral story. We are currently witnessing a liquidity event horizon where the traditional mechanisms of price discovery are failing. While global industrial titans like Samsung are hunting for 50 million ounces to power the next generation of solid-state technology, the registered silver inventories, the specific category of metal actually available for physical delivery, have reportedly plummeted toward a ghost town level of just 5 million ounces. This creates a staggering 10-to-1 leverage gap. In the language of macroeconomics, this isn't just a shortage. It is a systemic fragility that threatens the very solvency of the paper short market. The hook for the professional observer is the sudden realization that the paper price of 79 is decoupled from the physical price of survival. When the world's largest exchange faces an inventory drawdown of over 70% from its 2020 peaks, the market enters a force majeure danger zone. We are seeing an historic London to New York arbitrage blowout, where metal is literally being flown across the Atlantic to plug holes in a sinking ship. This is the inventory end game. For decades, the COMEX has relied on the assumption that only a tiny fraction of contract holders would ever stand for physical delivery. But when a leaked executive recording reveals that a tech giant is in a procurement panic, that assumption evaporates. One single delivery notice from an industrial player could now theoretically wipe out the entire available supply of the world's most liquid silver exchange. The economic engagement here is found in the short squeeze of a generation. If the COMEX vaults are truly hitting these empty signals, then the short positions held by bullion banks are no longer just risky. They are mathematically impossible to cover with physical metal. This is why we are seeing borrowing costs for silver spike to historic, annualized triple digits. We are moving from a buy the dip market to a take delivery at any cost market. As the 79 floor turns into a 100 launch pad, the true value of silver won't be found in a digital ledger, but in the hands of those who realized the vaults were empty before the music stopped. The question isn't whether the price will rise, but how many paper contracts will simply be settled in cash as the physical metal disappears into the private hoards of the tech elite. Would you like me to expand on key point 3 to analyze how China's new 2026 export licensing system is about to pull the final plug on Western silver liquidity? In the high-stakes game of global resource sovereignty, we have reached a definitive turning point as China moves to tighten its grip on the world's most critical industrial conductor. Starting January 1st, 2026, the Chinese Ministry of Commerce will implement a rigorous government licensing system for all silver exports, a move that effectively weaponizes a metal essential to everything from 5G infrastructure to Samsung's solid-state revolution. China currently controls a dominant 60% to 70% of the world's refined silver supply, and by mandating that only state-sanctioned firms with massive production capacities and multi-million-dollar credit lines can export, they are essentially pulling the plug on Western secondary markets. This is the ultimate geopolitical hook. Beijing isn't just regulating a commodity, they are creating a state-sponsored supply vacuum designed to favor domestic high-tech manufacturing at the expense of the rest of the world. The economic fallout of this licensing lockdown is immediate and severe. For years, Western industries have relied on the steady flow of Chinese silver to mask a growing structural deficit that has persisted for over 5 consecutive years. By restricting this flow, China is forcing a global reshoring of silver demand that the West is physically unprepared to meet. We are witnessing the birth of a two-tier market where silver inside the Chinese firewall remains accessible for their own EV and solar giants, while Western manufacturers like Samsung and Tesla are forced to scramble for the scraps left in dwindling COMEX and London vaults. This isn't just a trade barrier, it's a strategic siege of the green energy transition. Moreover, the timing of this policy is a masterclass in economic leverage. As silver prices test all-time highs near 80, China is ensuring that the real, physical metal stays within its borders to hedge against global currency volatility. The hook for the global strategist is clear: if you control the silver, you control the future of technology. Tesla's Elon Musk has already signaled the alarm, noting that silver is irreplaceable in modern industrial processes. We are moving toward a scenario where a 100 price tag isn't driven by investor greed, but by industrial desperation. When the world's leading refiner closes the gates, the paper price becomes an irrelevant relic. The real economy is about to find out exactly what happens when the world's primary source of digital and physical silver decides to stop sharing. In the high-velocity world of global arbitrage, we are currently witnessing the terminal stages of a pricing coup, as the Shanghai Gold Exchange effectively strips the New York COMEX of its power to determine the value of silver. For decades, the paper price, set in the West, dominated by high-frequency trading and massive short positions, has dictated the market, but as of late 2025, that system has fractured beyond repair. The hook for every macro economist today is the staggering $5 to $8 per ounce premium currently being paid in Shanghai over the New York spot price. This is not just a minor market inefficiency, it is a full-scale decoupling. When the world's largest physical silver market in China consistently trades at a 10% to 15% premium, it creates a massive drain on Western vaults. Any available silver in London or New York is being vacuumed up and shipped east to capture that spread, leaving the COMEX as little more than a paper ghost, with no metal to back its contracts. The economic reality is that the West is pricing silver as a financial instrument, while the East is pricing it as an endangered industrial necessity. We are seeing what analysts call deep backwardation, where the immediate price of a physical ounce in Shanghai is vastly higher than the future delivery price in New York. This signals a fundamental lack of trust in the Western paper promise. When Samsung or other tech giants realize that a COMEX contract may only offer a cash settlement instead of the 50 million ounces they desperately need, they will bypass the Western exchanges entirely and move their liquidity to Shanghai. This liquidity migration is the final nail in the coffin for the current 79 resistance. If the real price is already $85 or $9 in the East, the Western market is merely a lagging indicator waiting for a violent vertical catch-up. We are moving into a truth in pricing era. The traditional bullion banks, which have used paper leverage to suppress prices, are now caught in a mathematical trap. They cannot buy back their short positions because the physical metal is already gone, shipped to the highest bidder in the East. This decoupling is the true black swan event of 2025. It represents the collapse of the Western-centric commodity model. As the 100 explosion looms, it won't be driven by a change in sentiment on Wall Street, but by the cold, hard reality that the East has the metal and the West only has the receipts. The question is no longer if the price will break out, but whether the COMEX will even exist in its current form once the physical vacuum is complete. In the calculus of global supply chains, we are witnessing a phenomenon that economists define as one-way consumption, a terminal trap that is effectively erasing the world's above ground silver stockpiles. Unlike gold, which is meticulously hoarded and recycled at rates exceeding 90%, silver is the disposable workhorse of the modern age. As of late 2025, over 60% of annual silver production is funneled into industrial applications where the metal is used in such microscopic quantities: nanowires in smartphones, conductive pastes in solar panels, and microscopic layers in Samsung's solid-state batteries that it becomes economically lost. We are not just using silver, we are spending it. This is the ultimate hook for the macro investor. While the paper market focuses on 79 support levels, the physical market is grappling with a cumulative 5-year deficit that has now surpassed 820 million ounces. We are essentially burning through an entire year's worth of global mine production just to keep our digital world from going dark. The economic gravity of this situation lies in the recycling paradox. Despite prices testing record highs, the rate of secondary silver recovery from electronics remains abysmal, often hovering below 20%. The cost to chemically extract a fraction of a gram of silver from a discarded circuit board often exceeds the market value of the metal itself, even at $80 an ounce. This means that as Samsung ramps up its 50 million ounce procurement, it is competing for virgin silver that has never been mined rather than recycled stock. We are witnessing a permanent inventory drawdown where the vaults of the COMEX and LBMA are acting as the world's emergency buffer. Once these central reserves are exhausted, a reality signaled by the current 5 million ounce registered low, there is no secondary reservoir to tap. This technology-driven scarcity creates a value floor that is virtually immune to typical market corrections. In a deflationary collapse, luxury goods fail. In a technological era, essential conductors become priceless. We are entering a regime where silver is becoming a strategic mineral rather than a mere precious metal. Governments are beginning to realize that you cannot build a 5G network, a stealth fighter, or a solid-state EV fleet without a metal that is being discarded into landfills daily. For the professional analyst, this irreversible consumption is the most bullish fundamental in history. It ensures that any dip to 79 is met with immediate industrial buy pressure, as manufacturers realize that the ounce they don't buy today may literally be gone forever tomorrow. The 1/100 explosion isn't just a price target, it's a mathematical adjustment to a world that has finally run out of its most useful metal. In the arena of behavioral economics, the 79 level has evolved from a mere technical resistance into a psychological Rubicon that is fundamentally altering institutional risk appetite. We are currently observing a high-stakes hook in market sentiment. As silver stabilizes above this threshold, the fear of missing out is no longer a retail phenomenon. It has moved into the C-suite of the world's largest pension funds and industrial conglomerates. For years, the 30-50 range acted as an anchoring bias, convincing many that triple-digit silver was a fringe fantasy. However, as the 2025 bull run erodes these old reference points, the collective market psychology is shifting toward a scarcity mindset. When an asset breaks through a decade-long ceiling and maintains stability, it triggers a paradigm shift where the risk of being short or of the market suddenly outweighs the risk of buying at a record high. This psychological pivot is fueled by a feedback loop of deteriorating confidence in the paper trading system. As institutions watch the COMEX registered inventory evaporate to 5 million ounces, while Samsung's 50 million ounce demand looms, they are abandoning the wait for a pullback strategy. In economics, this is known as inelastic demand driven by panic. The 79 floor is now acting as a launchpad for momentum algorithms that are programmed to chase breakouts. We are entering a phase of hyper-awareness, where every news headline, from leaked recordings to China's export licensing, acts as a catalyst for a massive rotation of capital out of yielding assets and into the safety of the white metal. The real engagement for the sophisticated strategist lies in the short squeeze of sentiment. There is a massive pool of capital currently sitting in long gold, short silver, pair trades that is being forced to unwind as silver's outperformance becomes undeniable. This forced buying creates a self-reinforcing upward spiral. As the 100 target moves from a possibility to a mathematical probability, the market enters a mania phase characterized by a total lack of sellers. At a 79, the question is no longer about valuation, it is about allocation at any price. The 100 explosion will not be a slow climb, it will be a violent repricing driven by the realization that in a world of empty vaults and state-sponsored shortages, the price of an ounce is whatever the person holding the physical metal says it is.